Hi, this is Jim Cunningham. I have Shannon Behan with me from Ascent Wealth Management, and today we are going to talk about risks of retiring in California, what you need to know. And a lot of people who live in California are thinking about retiring in California. They are also thinking about leaving California. And there are other people, believe it or not, who live outside of California who are thinking about retiring in California. So we're going to cover that, and we're going to focus. This is going to be focused on the investment side and the finance side. And so even a small decision, right, can make or break your retirement. When you retire, if you retire when the stock market starts going down and you put all your eggs in that market, we're going to talk about that, the difference between that and having a little bit more disciplined approach. We're going to uncover hidden risks, sequencing of returns. And if that just sounds like a different language, Shannon's going to help unpack that. We're going to talk about obvious risks, market fluctuations. We're recording this in July of 2025. We've had significant market fluctuations so far this year in 2025, and it could have been a disaster for a lot of people if they had sold at the bottom, before the market came back up. And then how do you balance risk tolerance with your investment strategy? So it's very important. What we're going to go through is we're going to kind of demystify this strategy of, well, maybe if you just put it in an index fund and forget it, that's great. But we're going to talk about what happens in the real world with real investors. If you're watching this on YouTube, please subscribe to our YouTube channel and please share your thoughts. So if you agree with our content, post a post a comment. If you disagree, please post a comment. If you see somebody's posted a comment and you want to add your 2 cents, go for it. That's what it's for. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for over 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, a real estate broker, securities and insurance licensed, as well as a pilot single engine land instrument rated. But I'm not current. So a broad background. These are the lawyers currently in our firm. We handle all things peaceful transfer of wealth from one generation to the next. We help people set up trust. We help people dissolve trusts after somebody dies. We also help with LLCs and real estate transactions. That's sort of part and parcel of estate planning. And today I'm very happy to have Shannon Behan with us from Ascent Wealth Management. She's a certified financial planner, and I promise she will be doing most of the talking once I'm done doing a lot of the talking at the beginning. This is a disclaimer, very important. This is the legal disclaimer. I'm a lawyer. My lips are moving. Words are coming out of the mouth. You're watching this or listening to it. Maybe you're taking a walk. This is not legal advice. Seriously, this is not something where you should look at this and go, if I'm talking and saying something, go, Jim said, I'm going to go ahead and do this or that. This is not legal advice. When I say you, there's no attorney-client relationship implied by me using the term you. And Shannon, here is your disclosure. Maybe you can walk the listeners and viewers through it as well.
Sure. Thanks, Jim. Happy to be here. Very similarly to Jim and his disclosure, I am a certified financial planner, a financial advisor, accredited estate planner as well. But nothing that I'm saying today is a recommendation or advice to you specifically about your situation. We're going to talk a lot about different scenarios and best steps, but every single one of the recommendations that we'll talk about today needs to be based on your own individual situation.
Well, let's talk about risks in retirement. And I will tell you, I am in my mid to late 50s. I'm, sort of middle 50s. And I'm starting to think about it. I'm starting to think about, what does that look like? Is that for me? Should I keep working? Should I not keep working? And
Mhm.
I think a lot of people I know that I talk to, some people say, I can't wait to not go into the office or do whatever it is. Other people, they're not so sure. Maybe they might work through retirement. But what we're talking about here is this is when people typically stop accumulating wealth, right? They hit retirement, and now it's about, am I going to outlive my money? And I know for the vast majority of people, that is the number one concern. Am I going to outlive my money? With that, Shannon, take it away.
Sure. And I think that word retirement they're so emotionally charged, right? Like there's so much to look forward to about freeing up your time to be able to invest in the things that you've wanted to do, whether that's family, volunteer opportunities, those sort of things. So there's so many wonderful things about retirement. But I think the word in and of itself still quite honestly induces a lot of fear for a lot of people because they're thinking about that change in the life phase, if you will, from spending so many years working, accumulating assets assets, building that nest egg, to then switching gears and cracking that nest egg and having to create income for themselves. That fear of outliving your money, Jim, absolutely far and away is the number one thing that we hear from clients. And it is a big risk when we think about risks in retirement. Now, we've done webinars before in the past talking about risk, specifically about investment risk. And we'll touch on some of those things today. We've also done webinars in the past about risks of sort of proceeding with retirement without having the proper plan in place. But what we'll focus on today is more so the risks that are involved within a retirement plan. What are the things that you need to be thinking about? What problems are we trying to solve for when we are building a plan? So we'll cover everything that's listed here. Behavioral risk. This one is, if you've ever heard us talk before, this is always something that we hit on. To oversimplify it, sometimes our role as financial advisors is simply to save people from themselves. There are so many emotions involved with investing, and we'll look at, how those emotions actually do really impact people's outcomes. We'll talk a bit about investment risk. What are some of the things that we need to keep in mind when building a portfolio? We'll talk about sequence of returns, which is a little bit technical, as you mentioned, Jim, but I think it's very important to understand why that specific phase of creating an income stream for yourself can be so riddled with potholes, if you will. And then, perhaps very timely with some of the bills that we've seen coming through recently, but taxation, that's always something that we're going to be thinking about in retirement. And finally, longevity risk, not outliving your money. I think that's always something important to touch on.
And as you're talking, I'm thinking about taxation. I'm thinking about the clients. We cover this in other webinars that have done uh, Roth conversions. That someone has a larger IRA and maybe they retire at 60 and they don't have earned income at age 60, and you don't have required minimum distributions until age 73. A lot of people look at a Roth conversion. I will also tell you, retirement, you may not want to view this as static. So in your go-go 60s, and we cover this in other webinars, in your go-go 60s, you might be going a lot of places. I was on a meeting with a client from Florida, actually, and she said they basically live inside of their house in air conditioning, and it's very expensive to travel because every place they want to go, they have to get on a plane to go. In California, you don't necessarily have to get on a plane. You can drive to Carmel, you can drive to the mountains, you can drive to the desert. These are all drivable. So I guess part of this is kind of maybe a non-economic analysis about retiring in California, but it's something to think about that, maybe California isn't the place you want to be in your 60s because you're maybe traveling abroad a lot and maybe you're doing a tax plan or Roth conversion, but maybe in your 70s, that's when you settle in California. Those are the slow go years. And of course, your 80s are the no-go years. But let's talk about common investor mistakes.
Sure. Yeah. So this is something that we are trying to tackle pretty consistently with clients in terms of implementing plans that have been put in place. I think, Jim, to your point about, looking forward and sort of really thinking about what do you want those retirement years to look like? What we see often is couples just having that goal of retiring, meaning no longer going to work, but not really having any plans beyond that of what they want life to look like in those first 5 to 10 years and the 10 to 15 years after that. So, not having clear goals, both individually and also as a couple. If you're part of a couple, I think that's important to make sure that you're on the same page there. A lot of these other mistakes that we commonly see are specifically around investments. That desire to constantly look at the markets and perhaps make trades based on what you're seeing in the markets, whether that's chasing a trend or trying to time things correctly, that can cause too much turnover in portfolios, right? So too many trades, which that can cause taxation, just depending on what sort of account registration you're trading in. And that can cause actual income, ordinary income rate taxation versus capital gains tax rate. So we see that pretty often, turnover also hurting the performance, but also creating that tax issue. Failure to diversify. This is something that we see big time in California specifically, especially with people who have been employed by some of those big tech names.
Yep.
That were part of their compensation structure is equity compensation. So both while they're working, we see an over diverse or lack of diversification allocation in their investments, but also considering risk. If all your income is coming from one company and you've got a big portion of your portfolio invested in that company as well, your health in terms of financial picture can be really tied to that company. So California specific, that is a big risk we see. Taking on inappropriate risk just in terms of, I would say more often than not, where we see this happening is chasing those headlines. If there's a big company that's a buzz in the news, we see investors wanting to get involved. And when things are really looking positive and people are having wonderful experiences in the market, we tend to see people piling more money in after those big gains, which can lead to really, quite honestly, poor timing of investment decisions. This is something, Jim, you and I have talked before about is in actuality, we do see people buying at highs quite often because of that emotional excitement. And then the flip side of that is true as well. When things do not go well and markets are coming down a little bit, we also see that as a catalyst oftentimes for people to sell, which can be selling at lows, unfortunately, as well. So that last bullet point there, letting emotions rule, all these things really boil down to that.
Yeah, it reminds me in April when the stock market in
Hmm.
April 2025 and the stock market was way down. I was speaking with a close family member and I said, "Do not sell." Like I know that viscerally in your gut, you're like, "Oh my gosh, it's down 20%. I got to sell." That is the worst time to sell. Okay, when everyone is selling. And I think that's what you're talking about on the letting emotions rule is when there's a drawdown, when the stocks go down, people's like, oh, I'm getting out of the market. I can't, I've lost 20% or 10%. I just can't take anymore. That is not the fact that, I mean, this actually begs another question. If that makes you so upset, maybe you shouldn't be in those investments in the first
Hmm.
place, which is a whole other conversation.
Well, that's that whole point about, to that taking on inappropriate risk. Risk can be inappropriate for your goals and your plan, but it can also be inappropriate for your own kind of tummy factor,
Yeah.
if you will. If you're not able to stick to that plan, then it is not an appropriate level of risk. Jim, that is a lot of what we do, especially when there is market turmoil, is kind of keep people locked into those plans because um, what can tend to happen is what's the results of the study that we're looking at right now, which is called the Dalbar study. And this study is updated pretty frequently, and it looks at different rolling time periods, 20 years, 25 years, 30 years. And across all those time periods, the numbers are different, but the trend is the same. And what we're looking at here is the index performance. So indexes are, what you see in terms of the market being up or the market being down when you turn on the financial news. So this is index returns versus actual investor returns and investors who are investing in those indices. This particular Dalbar study is a 20-year period. 2005 through the end of 2024. And it looks at if you would have invested $100,000 at the beginning of that time period in the S&P 500 and not touched it, just let it ride. At the end of 2024, it would have been worth about 717,000. That's that first big bar that we're looking at there. But what we actually see with individual equity indices investors is that their actual experience, their growth of 100,000 is really only to 585 or 586. The reason for that is the timing. It's getting scared and selling or buying in when things are frothy and people are excited. So even though the index does a certain percentage over time, what we're seeing is that actual investors in that index are not experiencing that. Over on the right-hand side, you can see the index performance, 10.35 for the index versus the actual investor of 9.24. So just purely based on decisions about timing and that behavior that we're talking about, over 20 years, this clients are experiencing 1% less in annual return. And that's the equity indexes. The case for fixed income indexes or bonds is
Mm.
even worse.
Yeah.
You can see underperformance there is an annualized over 3% a year.
Yeah, it's interesting that and it's interesting how the effect of 1% changes those numbers over a 20-year period. So it really has an outsized effect. You wouldn't think that that would be a 1% difference. So in those returns,
Yeah,
interesting.
absolutely.
Okay, common risk measures. You're going to cover this: alpha, beta, standard deviation, and Sharpe ratio. I look at this, I barely understand it. I want you to know.
Mhm.
I I pulled some people in the office before we did this. These are smart people. They're like, I think I understand what's going on. And that's kind of the point of this slide is
Mhm.
there's a lot of stuff out there that's pretty complicated. It's understandable. I think if you give it enough time and enough thought and
Mhm.
enough attention, but maybe unpack this for people who are listening.
Sure. So the reason that we like to talk about these things and understanding that this is technical and complex and probably beyond what many of you even want in terms of knowledge. But I think it's important to really isolate what's important when we're talking about performance of a portfolio. So alpha is a measure that you might hear from time to time, and alpha is really talking about performance. It's talking about a portfolio's performance representative to something that you're measuring it against, an index. So alpha looks at performance alone. Beta is another risk measurement that looks at the volatility in a portfolio. It looks at the spikes up and the spikes down. How much risk is there in terms of movement? Beta and standard deviation measure those. And so, on their own, those can be data points that are important, but the magic really happens when you combine those two aspects, both risk via volatility and the actual performance. So, we as financial advisors look at a ratio called the Sharpe ratio. Again, very technical. You'll probably never need to know how to calculate a Sharpe ratio. But what Sharpe ratio does is it combines those two components. It considers both the performance of a portfolio and also the risk that is necessary in order to attain that performance, which is what we call the risk adjusted return. So if we look at the next slide, we actually have numbers that will show you an example of this Sharpe ratio calculation. Portfolio A, just to keep it very simple, on the left-hand side has a return of 14%. Portfolio B returned just over 11%. So I think on its face value, if we were only looking at performance, every single person would choose portfolio A. That return is better, right? But how much risk did we have to take on in order to attain that performance? So we look at standard deviation, which is the risk measurement. Standard deviation of portfolio A is much higher than standard deviation of portfolio B. So that's why we calculate the Sharpe ratios. It gives us an apples to apples comparison of two portfolios side by side, one number, two portfolios. The way I think about Sharpe ratio is that for every unit of risk you are taking on, or excuse me, for every unit of performance that you get, how much risk did you have to take on to get that? So for every unit of performance in portfolio A, we took on 1.3 units of risk. For every unit of performance in portfolio B, we had to take on 1.5 units of risk. So portfolio A has a much more attractive risk-adjusted return, meaning we were able, or excuse me, portfolio B does because we were able to get a much better risk-adjusted return in that portfolio. So it's important to consider, you could just throw everything in an index fund, for example, the S&P 500 index fund. 33% of that exposure would be in seven stocks right now. But the risk that you are taking on when you are investing in only one index with no consideration of other asset classes is not as attractive as perhaps a more broadly diversified portfolio that might have slightly less return in certain time periods, but over time should have a much smoother ride.
Yeah, and the S&P 500, just to be clear, that is not it's 500 stocks, but it's not like 500 equal investments in a stock.
Mhm.
Because you said 33% of that S&P 500 is in seven stocks and those are seven tech stocks, right? I mean, that's the
Absolutely.
seven, right?
Absolutely.
So when you look at the S&P 500, it's heavily tech oriented, which, we're on this sort of this cusp of AI and a whole AI revolution and a revolution in the way people work, which I think there's a lot of, there's a lot of talk about it. And that may be where a lot of the return is, but that may be also be volatile, right? It could be what is your risk? Some of these companies may implode, some may go 10x. Who knows, right? We just don't know.
Absolutely. And that is, I think, when we think about portfolio construction and kind of what are some of the considerations to manage this portfolio risk, We have to consider that volatility because any downside, when the portfolio comes down and you then have to recover from that, that is so much harder than if you are kind of having that smoother ride. Which visually, here's what that looks like. So these arrows on the bottom, these are the mathematical calculations for if we have a pullback of 10%. You don't need a 10% return to get back to where you started. You need an 11% return. And as you crank up the dial on those negative returns, if we have a pullback of 30% in a portfolio, we now are in a situation where we need a 45% return just to get back to where we started, not even to be gaining. 45% on the downside is 82% required to as a return to get back to where we started from. So by
You know,
having
I'm
proper
sorry, go on.
diversification and that asset allocation consideration, meaning very different types of assets coming together to build your portfolio, that's how we sort of mitigate some of this volatility in a portfolio.
As you're talking about this, I'm wondering about taxes because one reason I think people leave California is there's no income tax in a lot of other states. And so a lot of people say, well, I'm going to leave California so I don't have to pay California income tax. At what income level is California income tax a big deal, do you see for your clients? Is it where they're like, wow, this is really something I'm worried about? Or is that a good way of looking at it, an income level?
I mean, I think for what I generally see is that for even income earners who are on the lower side of income, the California brackets are still to the point where those clients in lower income brackets still find it attractive to consider opportunities to perhaps move to a state like Tennessee or to Florida that doesn't have that income tax. And especially for a lower income earner, it might be more important to keep even more of how much they earn. So I wouldn't necessarily say it's a dollar amount. I think it's more about the sources of income as well, right? Because we oftentimes see clients with very high embedded capital gains in portfolios.
Right.
They made an investment a long time ago. That investment has now appreciated and they have embedded capital gains. So they're kind of locked in because if they sell that asset, they benefit from the capital gains tax rate at the federal level. But in the state of California, you're paying regular income tax rates on those capital gains. So it can be a very attractive, earlier you mentioned Roth conversions as
Yeah.
something that you might want to move out of state to do, even capital gains, realizing capital gains, that can be attractive to do in other states as well.
Also, if you're not a so I would say California source uh, realization of capital gains, meaning you bought a piece of California real estate. Now, you could do a 1031 exchange or a 721 exchange, and we talk about that in other webinars, so that you're not immediately paying those capital gains tax. But if you like, let's say you bought Nvidia at a very low price, and now it's a very high price, and you have a couple $1 million capital gain that you want to realize. That may be a couple $100,000 in California income tax that you would have to pay if you sold that stock. If you're not a California resident, if you're a Nevada resident, a Tennessee resident, a Florida resident, and you sell that stock, you are not paying California state capital gains tax or California state income tax because those are publicly traded securities. But if it's California real estate, or maybe you own a company in California, maybe you own a company in a corporation that's taxed as an S corp, subchapter S. When you go to sell the assets of that corporation, if it's located in California, you're going to pay California income tax because it's California source income tax. So I think this is this is part of the picture in retiring in California. Does it make sense to retire in California? I guess part of this question was, is there a way to factor in taxes, like tax drag, and how does it affect these numbers? So if your account goes down, if your stuff goes down in value and you sell, let's say you panic and you sell, and then you rebuy something that goes up in value, and now you want to sell to realize the gain, you might be stuck. You might be in a more it's a less tax efficient structure if you're a California resident than not.
Oh,
If that
absolutely.
even makes sense. That makes sense.
Absolutely. We see a lot more for California residents. We see taxation coming into those investment decisions a lot more than in other states for that reason, Jim.
Yeah.
Um, So there are some strategies that we can create, whether that's, municipal bond portfolios, for example, that are very tax efficient with no tax in the state of California, if you buy California muni bonds. So there are, that's definitely a consideration in portfolio construction, but sometimes we just can't get around it. If you've had that NVIDIA stock for years and embedded capital gains is going to be a problem. Kind of switching gears a little bit, I think sequence of returns risk. This is really a risk that is unique to the distribution phase, if you will, of life, where you're taking that savings that you've accumulated and creating an income stream for yourself, starting to take portfolio withdrawals to sustain your lifestyle over time. The reason that we always talk about sequence of returns is because it has a very dramatic impact, and it is something that needs to be watched for constantly. So this isn't something that you can solve for, at the onset of retirement. You are constantly needing to be monitoring what's happening in your portfolios and what that retirement income strategy looks like. To really illustrate it, this slide and the next compare two different scenarios of someone who's retiring at the end of 1994. And in particular, David here invested $250,000 and began taking a 5% withdrawal when he retired. You can see that the 1995, 96, and 97 were amazing years in the S&P 500. So he had really good returns in those first several years when he was starting to take withdrawals from his portfolio. After 20 years in retirement, that $250,000 has now grown to over $1 million for David. The kind of opposite scenario would be for Monica. Monica retired at the end of 1999, just a few years later, same 250,000 invested. But as we all remember, with that dot-com bubble, 2000, 2001, and 2002 were not great years for the S&P 500. So not only did Monica start taking withdrawals from her portfolio, she also had portfolio losses. And so we fast forward 20 years for Monica, and at the end of 20 years in retirement for her, rather than having $1 million like David did, she's taking the same size withdrawals as he was. Rather than having $1 million, she's got under 100,000 after that first 20 years.
So they both start with 250,000.
Mhm.
They each take out 5% annual withdrawals, and one person has 10 times the
Mhm.
wealth that the other person has. So what should Monica have done? Should she have not retired? Should she have put it all in cash? What I mean, it's pretty obvious what she should have done, right?
Mhm.
Because we know with hindsight. But if you're going to advise someone who's retiring in 2025,
Mhm.
and they've got 250, I mean, I don't know if the number probably a million
Sure.
now with inflation or whatever, but
Yeah.
what's the advice someone who's facing retirement this first 3 years? What do you recommend?
Yeah, you've got to diversify, right? So that means a couple different things. The first is simply diversification of investments. So in both of these scenarios, they are invested 100% in the S&P 500, which as we talked about is a very high risk as compared to some other choices that you would have in terms of investments. So at its very simplest, the first step would be diversification of investments. Having some other part of your portfolio that is in a more conservative, more stable type of investment that you can draw on so that you don't have to take money out of your S&P 500 investment when things are down. Having that more conservative, stable part of your portfolio to draw on is kind of step one. The other way that I would say considering diversification would be when you are creating a retirement plan, creating that retirement income plan, diversify streams of income. So rather than just planning on, if you've got a certain bucket of assets available, rather than just looking at that as one bucket for withdrawals, I would diversify that. So maybe there's one part that's in a liquid investment portfolio like this. There's other tools available. Maybe that's something like an annuity, for example, that can create an income stream for you in retirement. That's an insurance contract that creates a guarantee around that. Also diversifying in terms of maybe we see a lot in California. Rental real estate, for example, to create that income stream for you. So not just having one homogeneous plan or source of income, I think is very important.
What about somebody who says, maybe they invested in these, three or four stocks that have really outperformed? And we have a client that I meet with every year or two, and I'm kicking myself because 10 years ago, he was investing in NVIDIA and Apple, and Tesla, and all these that have just kind of exploded. And I'm just like, I wish I could go tell myself, invest exactly how this client invested.
I know,
I
right?
might not
The
even be on
coulda,
this
woulda,
webinar.
shouldas.
I don't
Yeah.
know. I think we're all kind of kick ourselves. But what about someone who has a concentrated position and they're
Mhm.
worried? What are some strategies that you can use to help those clients?
Sure. So there's a lot of different vehicles that we have available to us these days. And it really, as talking about disclaimers and
Yep.
disclosures, it really does depend on someone's overall financial picture, right? If they have a very large estate, for example, there's certain charitable vehicles that we could use to sort of mitigate realization of capital gains and create income streams. We can also use vehicles where you contribute your appreciated stock, for example, into a fund with other people who contribute their appreciated stock, and you all share in the ownership. So rather than owning just the Nvidia shares that you have, you now have exposure to, some Apple shares that someone else had. So those are called exchange funds. There's also strategies that we can use to sort of build out portfolios around your concentrated position and strategically harvest losses to help offset realization of some of the gains in your portfolio. So there are, even though sometimes it can feel like you're locked into those embedded capital gains, there's a lot of strategies that are available when you look at the big picture to sort of offset that and diversify away from that concentrated position. But it really just depends on how all the pieces fit together.
Yeah, and we all are going to pay on long-term capital gain. We're all going to pay the maximum rate. If you have enough, the maximum rates are 20% plus 3.8%. A lot of people forget about this. This is if it's over 250,000. If you're married filing jointly, so it's 23.8%. California tax on another 13.3. That brings it to 37.1. So if I'm staying in California, if I'm a lifer, which full disclosure, I'm a California lifer. I'm not going anywhere. That's 37.1%. My cousin in Texas selling the same stock is going to be 23.8%. And believe me, they're complaining. Oh, these taxes are too high. You're lucky you're not in California. But 37.1 is a lot. So especially if you're going to stay in California, if you're worried about those taxes, there are these other strategies that are out there. And if that's something you'd like to talk about with, you can reach out to Shannon, you can reach out to us, and we can certainly help you with that.
Mhm.
Let's look at, I love this chart because this is like, this is the don't panic chart.
Yeah.
It reminds me a little bit in the Bible, whenever an angel appears, the very first thing the angel says is don't be afraid. It's because it's really scary. This is like an angel, the angel of death appearing on these lowest bars here. But tell me what this is.
Yeah, absolutely. So each one of these bars represents a year, a calendar year of returns for the S&P 500. The orange part of the bars represents at any point inside that calendar year, how much was the S&P 500 down at any point. So I'm going to look at 2020 for an example. So in March of 2020, when things were really looking negative with COVID and things shutting down, at one point the S&P 500 was down 34%.
Crazy.
Now, the blue portion of the bar shows where the S&P 500 finished for that calendar year. So we can see that in 2020, the S&P 500, despite the fact that at one point it was down 34%, it finished 2020 up 16%. And so I think, Jim, I totally echo your thoughts about this graph, or it's one of my favorites to show that even when things are looking really bleak, the chances that they finish the year better than where we're at. I mean, even look at '08. '08 was nasty, right? At
Yeah.
one point, though, we were down 49%. We finished down only 38%. But I also think in the context of the discussion that we're having today, especially around sequence of returns risk. This is why it's so important to not have a kind of set it and forget it type of situation. You really need to be monitoring things on an ongoing basis. Because even though in 2020 things were positive, 16%, if when things were down 34%, you were drawing on your portfolio at that point, you would not have finished up 16%.
Right.
Your experience would have been very different.
And that's your point of the buckets. So it makes sense to have. I'm just going to use an example. This don't hold me to the numbers. Just 80% is like S&P 500, 20% is cash. So
Mhm.
what you've got maybe 4 years of cash in there, or whatever the numbers are, but you're
Sure.
not liquidating. This is really important. I think this is probably the biggest takeaway.
Mhm.
You're not liquidating the actual fund to live on, you're living off cash, maybe the dividends that are kicking off or other revenues, other streams of income, especially in California, because again, those capital gains tax, if you're selling something, you're paying income tax on that just like you were earning the income. By the way, the capital gains tax combined rates are 37.1. In California, it's 53.3 or maybe it's 53.6. It makes me sick every time I go over 50% on tax, but that's 37 federal, 13.3 state plus 3.8% net investment income tax. And that's a big number. Certainly on the income side, if you're talking about retirement income or
Mhm.
RMDs from retirement accounts.
Absolutely. One of the major things that we look at when we're planning for someone is taxation. This is a visual of some of our planning software that we utilize. This is a very simple visualization, but it actually points out something, Jim, that you talked about at the very beginning of our webinar today. So this is looking at a projected cash flow for someone throughout their retirement. The red line on that particular chart shows their total expense load, and that includes taxation, right? So in the first couple of years, this client is still working. Those light blue bars represent their salary from working. And then they retire. And they've got a lot of income from that. Teal would be things like real estate, for example, real estate income. And they start taking portfolio withdrawals. That's the yellow portion of this visual here. And then a really important thing, especially for people in California, is the burden of those required minimum distributions that, depending on how old you are, will start at either 73 or 75. And we can see that when those start for this particular client, their total withdrawals now are exceeding their needs. So those orange bars represent their required minimum distributions. They're having to distribute taxable income that they don't actually need to live off of just because the government tells them they have to. So Jim, you talked earlier about an opportunity for Roth conversions between retirement and when RMDs kick in. And this is a great visualization of that. We can see that that red line of total expenses ticks down right after retirement. That's because of taxation. So what we do have the ability to do in situations like this is those orange bars that are in excess, we can front load some of that income into those years where there's just the yellow bars. And maybe we pay some of that income now, potentially in lower tax rates, so that in the future we're not kicking up into those higher rates. That's what I think is so important to have, near-term planning, but also to visualize out into the future. What is my tax burden going to look like? Where is my income going to be coming from? So that we have the ability to diversify uh, account registration as well, too, to create potential Roth tax-free pools of money for you, and really start to get creative even too about how that impacts your estate plan. I know for a lot of our clients, it's much more attractive to have their kids inherit Roth assets, because their kids have been very successful, are living in California as well, are paying really high taxes already. They don't want to gift them a tax bill by giving them IRA assets in the future.
One of the great things I'm looking at this for those who are lucky enough to retire before they hit their RMDs, and we're assuming that people have retirement accounts on this, right? That people have been putting away into
Mhm.
401k, 403b, TSA, whatever it is. Uh, maybe you retire at 60 and you go, I love California, but I love the rest of the world. I went to Italy a couple of years ago, and my wife and I were in Tuscany, Montepulciano, Cortona, these, Siena. It looks just like California, but it's so much cheaper and there's hardly anyone there. It's like, wow, this is great. That's what a great thing. Like you could spend 6, 7, 8 months a year in Italy. Maybe you spend a couple other months doing something else. I don't know, buy a little vacation home there, travel Europe, right? And while you're doing this, you're doing a Roth conversion, right? So you're really taking advantage of these lower tax brackets. And we cover this in other webinars. The math kind of works when you fill up a 24% tax bracket, which is right around 300,000 and 350 in income. But what's nice about that is you can convert these. If you're not a California resident, you can convert the Roth. You still have to pay the federal tax, even though you're in Italy. But you are able to essentially legally game the system so that when you return to California, maybe you're 70, 72, and you say, I want to slow things down. I really, spend time in the desert, spend time in Northern California, right, in the summers, whatever it is. Um, but what you're able to do is you're able to remove yourself from California, not be a California resident, so you don't subject yourself to those California income tax. And that might actually pay for your stay in Italy, right? When you kind of work it all out, would you rather give that money to California or use that on yourself for a good time in Italy? So just a little bit of an example, but something I've been thinking about for other clients. But my wife, she's like, I want to get one of those €1 places in Italy. And I was like, yeah, there's like no running water and it's a pile of rocks. Anyway, moving on.
I think this, Jim, probably is one of the things that people think about the most when they think about retirement and risk. So just kind of putting a bow on the discussion of the different types of risk with this. Um, Longevity risk means living a long time, potentially outliving your money. Um, I think that we should be thinking about a long life as a blessing and not a burden, right? So appropriate planning really helps us do that. It helps us make sure that we've got confidence that our funds and our plan are going to sustain us for life. Um, I am shocked, and I don't know if you have this experience, Jim, but I'm shocked by how often in working with clients and planning, that life expectancy is underestimated. People think, oh, I'm gonna, live till 80 and then I'm gonna kick the bucket. And then I'm sitting across from, them and their families when they're 92 years old and having to figure out what we're gonna do in terms of the portfolio. So, I think that is something to consider is that even if it's not in your family history, you could be the outlier. So we want to plan for a long life. And then given that we have that, even we're seeing a lot more early retirements, potentially early retirement combined with a longer life expectancy
Right.
is pushing that length of retirement years beyond the original, 25, 30 years. We're seeing people in retirement for 40 plus years. And especially in environments where inflation has been such a high talking point, we're seeing an environment where, in particular, healthcare inflation is running even higher than typical inflation. When Jim, you pointed out that impact of 1% on the Dalbar performance report. That's over a 20-year period. Imagine the impact of just a 1% difference in the cost. And inflation is running higher at 1% over 40 years of retirement. So that could really has the potential to erode your purchasing power or what your money is worth in the future. So that's something that we've got to consider. Um, I really like the visual that's on the screen here. It gives you the probability of living to certain ages when you're 65 years old. So, as a woman, if you're 65 years old and in good health, you have a 73% chance of living to 85. And then we even look at couples, right? If you've got a couple that's 65 years old, you're both in good health, there's a 73% chance that at least one of you is going to live till 90. So the odds are that we're going to be talking about long time horizons. So I would encourage you to consider that when we're doing planning.
Yeah, it's funny. It reminds me of my father-in-law, my late father-in-law, who kept saying, I think 90's enough. I just don't see myself living past 90. And I kept telling him for decades, okay, I want to talk to you when you're 89. Well, he reached 89. And he's like, well, I think I got 5 more years. I think he made it till 92. But
Yeah.
it is interesting how, as you get closer, because, when talking to clients about estate planning, this comes up. But I think you're right. A lot of people, it's hard first of all, it's hard to think about yourself being a 95-year-old person or a 90-year-old person, right? But it happens. The flip side of this is you may be the one financially responsible for parents, potentially grandparents. If you're financially responsible for your parents, this is very important. So a lot of our clients who are wealthier look at long-term care insurance for their older, maybe their parents or in-laws that they're going to take care of. And we've covered that in other webinars. And that's something really, if, we're talking about the context of this video is that we're talking about you retiring, but also think about, you may be the one financially responsible for a generation above you. So great graph there.
And to really, kind of just force this point home again, I think all of the things that we're talking about is why it is so important to work with someone who considers all of these things. Jim mentioned, and I pointed out that our entire team, we are all certified financial planners. We're all accredited estate planners because these decisions about something as simple as how to invest your retirement funds, for example, they are not isolated decisions. It matters so much the context of how all the pieces fit together, what your goals are, what your plans are. So, having someone who really understands those complexities and can help build a strategy to deal with all of these risks is so important. From things like investment strategy, helping you stick to the plan, those behavioral things that we talked about, retirement planning, where's your income going to come from? Understanding in different types of environments, potential market environments. Is your plan able to withstand some of that stress testing? And as I pointed out, I think numerous times, these things involve adjustment over time. Retirement plans are not something that I don't want anyone to think of it as a document that gets created when you're 55 years old and then that's locked in and that's your plan until you're 90. They need to be monitored. They need to be adjusted on a regular basis to make sure that they are aligning both with your own personal goals and how they evolve, but also the market, the environment, tax legislation, that sort of thing.
I think it's really important, what you've got listed here: investment strategy, retirement planning, tax planning, and estate planning. I think these things, the advisors need to work together. And, as we kind of come to a close on our materials here, I have seen a lot of mistakes avoided when the advisors work together, when the financial advisor, the attorney, and the CPA essentially they kind of know each other. They might have their cell phone number. They know each other professionally at a minimum. That is, I think, an optimal situation. Where we see a lot of problems is where these advisors have no idea. Somebody might have three financial advisors, a CPA, and an attorney, and none of those people talk to each other. I think that is that is a much higher probability of having some significant problems. One thing you didn't touch on is having more than one advisor. If I have two advisors and one sells Apple and one buys Apple within 30 days, that's called a wash sale. That has a tax consequence. And if you have multiple advisors, many times people just aren't paying attention enough to that. So that brings us to the conclusion of our materials. We have something very, very exciting on the next slide. And I'm going to do my best to read Russian. But we have offices in Northern and Southern California, in the Bay Area, Capital Region, and Southern California. Now, for those of you who might not know, my wife and I adopted our two daughters from Russia about 20 years ago, and we have an attorney on staff who is going to be doing a Russian language webinar, Estate Planning Basics, a webinar na ruskom yaziki osnovi plan I radivnaya ibushechkestva. Okay, terrible pronunciation of Russian, super rusty. But I'm not going to be doing that. So we have a native Russian speaker, Lana, who's an attorney in our firm. We also have an administrative assistant who is a native Russian speaker as well. So for those of you watching this in English, you'd be like, Jim, this is absolutely no help to me. But the point of this is we're about education. We're about meeting people on their own terms, if you will. And if somebody is maybe a native Russian speaker, not so comfortable in English, or maybe would like to hear this in Russian, then we are going ahead and we're going to have that July 17th at noon. So spread the word. And this is the contact information for Ascent Wealth Management. We will now open it up for questions. And so if you have any questions, we're doing this live. If you have any comments, put those in the comments. If you're watching this on YouTube, please subscribe. But go ahead and ask questions. And this is the contact information for Ascent Wealth Management. And Shannon, I want to thank you for joining us here today. This is a very, very important topic. I know it's emotionally charged, retirement, but thank you for joining us. And if you're watching this on YouTube, just keep watching because the next webinar or next video is going to roll right after this one.